They say the California housing market never really crashes. It just takes a breather. But as your hands tighten around the steering wheel, beginning this journey through the Golden State, you can almost feel the cracks forming beneath the tires. The headlines keep insisting things are stabilizing, yet the streets tell a different story. For sale signs collecting dust, neighbors whispering about price cuts, and a haunting quiet where bidding wars once raged. This isn't a glossy tour of dream homes and ocean views. It's a survival guide for what's really happening behind those manicured hedges. We're heading straight into the storm, exploring 10 California suburbs where the once unshakable dream is unraveling into a full-blown financial crisis. From the vast stretches of the Inland Empire to the high-priced heart of Silicon Valley, the deeper we go, the more alarming the data becomes. What we uncovered in the Bay Area, in communities shaped by the world's biggest tech empires, exposes a fragility few ever imagined. And when we reach number 1 on this list, a suburb long seen as the definition of wealth and security, you'll see a price collapse so steep it will completely change what you thought safe investment meant. If you live in California or are even thinking of buying here, you need to see this. Hit that like button, subscribe for more truth backed by real data, and let's fire up the engine. The road ahead isn't smooth. Number 10. Temecula. Our journey kicks off as we drive inland from the California coast, deep into Riverside County, where we pull into Temecula, once known as the ideal escape for families priced out of San Diego and Orange County. It was the picture of attainable luxury, vineyards, top-rated schools, and spacious homes that offered more bang for your buck. But now, that supposed refuge is starting to feel like a trap. The foundation of Temecula's housing market is beginning to crumble. According to Redfin's September 2025 data, the median sale price has slipped about 3% year over year. That may not sound catastrophic, but in a market that only ever seemed to climb, it's the first serious jolt. Sellers are in disbelief, and the panic is showing in the numbers. Zillow's latest figures reveal a 1.7% dip in home values, and more alarmingly, the buyers have disappeared. Homes that once sparked bidding wars now sit untouched. Redfin reports that the median days on market have jumped from 35 to 57, an extra 3 weeks of waiting, worrying, and paying the mortgage while nothing happens. Imagine listing your home expecting offers within a day, only to face silence for nearly 2 months. Reality is setting in fast. Over 1/3 of all Temecula listings, about 33.8%, have seen price cuts. Realtor.com backs it up, showing that the median listing price has plunged 5.5% in just a year. Sellers aren't trimming prices, they're hacking them down, chasing buyers that no longer exist. The power dynamic has flipped. What was once a frenzy-driven seller's paradise is now a graveyard of stale listings. Buyers hold all the cards, and they're making lowball offers without hesitation. If you purchased a home in Temecula in the past 2 years, chances are your home's value is already slipping. This is the first tremor of a bubble bursting, and as always, the shockwaves begin in the outer suburbs. So what do you think? Is Temecula just experiencing a temporary stumble, or is this the first clear warning sign for the rest of Southern California? Share your thoughts in the comments below. Number 9. Santa Rosa. We're heading north now, leaving Southern California in the rearview mirror and cruising up Highway 101 into the heart of wine country. Welcome to Santa Rosa, a place that's endured wildfires, rebuilding, and now faces a new kind of blaze, a financial one. Once considered resilient, this market was supposed to bounce back with insurance money and constant demand. But the latest data paints a completely different picture, one of rapid decline and growing panic. If Temecula showed the first tremor, Santa Rosa is feeling the full earthquake. According to Redfin's most recent report, the median sale price here has plunged 6.8% from last year. To put that into perspective, on a typical $700,000 home, that's roughly $50,000 in value wiped out in just 12 months. Zillow echoes this trend, recording a 3.7% fall in home values citywide. Homeowners who thought their equity was untouchable are watching it vanish before their eyes, and buyers, they're nowhere to be found. They're waiting, watching, and expecting prices to keep falling. The most alarming number is how long homes are sitting. Last year, a typical Santa Rosa home sold in 37 days. Now that figure has stretched to 60 days, a full 2 months. That's not a slowdown, that's a standstill. The bidding wars that defined the boom are history. Redfin reports that the share of homes selling above asking price has crashed by nearly 15 percentage points. Buyers aren't fighting anymore. They're negotiating hard, demanding discounts and winning. This is no longer a balanced correction. It's a full-blown buyer's market. For sellers, the panic is setting in. Those who bought during the peak are realizing they may have to pay just to sell, writing checks at closing to cover lost value. What was once the wine country dream is now tasting like a financial hangover. So, Northern California, what are you seeing out there? Is Santa Rosa's slump spreading through the rest of wine country, or is this just the beginning of something much bigger? Number 8. Roseville. Leaving wine country behind, we head east towards Sacramento, rolling into the sprawling suburb of Roseville, a place that for years was one of America's hottest housing markets. This was the dream destination for Bay Area escapees, swapping cramped condos for brand new homes with space to breathe. But that boomtown energy, it's gone. The party's over, and the hangover has begun. If there's one word to describe Roseville's housing market in 2025, it's capitulation. Let's start with the numbers. Redfin reports that median sale prices have dropped 2.2% year over year. Zillow's data echoes that story, showing home values slipping another 1%. The relentless upward climb has stopped, and now, gravity is taking over. But the real gut punch comes in how long homes are sitting on the market. A year ago, you could sell a home here in just 25 days. Now, Redfin says that figure has ballooned to 42 days, a 68% increase. That extra time on the market is deadly for sellers. It signals weakness, and buyers can sense the desperation from miles away. And here's the stat that truly changes everything. Zillow reports that over half, 50.6% of all Roseville homes are selling below their original asking price. Think about that. It's now more common for sellers to take a discount than to get what they're asking for. The seller's advantage has evaporated completely. What caused the reversal? It's simple. The remote work migration that once fueled this market has fizzled out, and the flow of Bay Area tech money has slowed to a trickle. The once flush buyers who drove prices sky high are gone, leaving locals stuck with listings priced for a world that no longer exists. Even the shiny new construction communities are hurting. Builders now find themselves in direct competition with a growing flood of resale homes, forcing them to offer huge incentives, rate buydowns, closing credits, free upgrades, anything to move inventory. Those discounts drag down the value of existing homes even further. Roseville was once the face of the drive-till-you-qualify housing boom, where people stretched further from the city to chase affordability. Now it's becoming the face of the bust. If you're in a new-build community, what are you seeing? Are builders cutting prices, throwing in bonuses, or offering special financing? Tell us in the comments, because the panic is spreading, and Roseville is the warning flare. Number 7. Lancaster. We're steering back south now, cutting through the high desert of Los Angeles County to reach our next stop, Lancaster. For decades, this city has been known as the final frontier of affordability for Los Angeles families. It was the last stop on the line for people chasing the California dream, a place where homeownership still seemed possible, but now, that dream is unraveling fast. Being the cheapest market doesn't shield you from a crash. In fact, it often makes you the first to fall, and Lancaster is proving that in dramatic fashion. The housing market here is suffering one of the sharpest declines in the entire state. Redfin's latest data is jaw-dropping. The median sale price in Lancaster has plunged 8% year over year as of September 2025. For a family that put down just 5%, that single drop means their entire equity has vanished, and they're now deeply underwater. Zillow's numbers confirm the pain, showing another 2.4% decline in home values on top of it. And then there's the inventory, an avalanche of unsold homes. Zillow lists more than 834 properties just sitting on the market, gathering dust. Redfin reports that the median days on market has jumped from 39 to 50, but that number hides the reality on the ground. We're seeing real-world cases of homes sitting for months. One recently sold home lingered for 128 days before the exhausted seller finally accepted a lowball offer. That's over 4 months of waiting, worrying, and losing money. This is a market where buyers hold every ounce of power and sellers are running out of options. The desperation is visible everywhere. And while Zillow data oddly shows that about 50% of homes sold above list price, that's a statistical illusion, likely driven by deep discounting on initial listings. The true story is the flood of price cuts, withdrawn listings, and crushed expectations. Lancaster's market isn't just slowing, it's in free fall. And the tragedy here is who gets hit hardest: the working-class families who believed this was their one shot at owning a home in Southern California. They weren't buying a forever dream, they were unknowingly stepping into a financial trap. So what do you think? Can markets like Lancaster ever bounce back, or is this painful new reality here to stay? Number 6. Fremont. We've officially crossed into the heart of it all, the San Francisco Bay Area. Our next stop is Fremont, a sprawling and diverse suburb that serves as the gateway to Silicon Valley. It's home to the Tesla factory, an ocean of tech commuters, and for years it represented the pinnacle of Bay Area prosperity. Fremont wasn't just a hot market, it was a rocket ship, and for a decade, it seemed like it could only climb higher. But now that rocket is losing altitude fast. The once unshakable tech engine that powered Fremont's real estate boom is stalling, and the numbers prove it. Zillow's latest report shows home values have dropped 3.9% year over year. That's a $60,000 paper loss on a $1.5 million property. Redfin echoes the same trend, reporting a 3.1% decline in median sale prices. But the real story here isn't just the price correction. It's the psychological shift that's sweeping through the market. Just a year ago, selling a home in Fremont was like striking gold. Listings were going pending in 14 days, often with multiple offers well over asking. Today, that number has stretched to 22 days. And while that might sound reasonable elsewhere, in the hyper-competitive Bay Area, it feels like forever. That slowdown has sent sellers into panic mode. Here's the statistic that tells you everything. According to Redfin, the share of homes selling above list price has collapsed by 24.2 percentage points. In plain English, nearly a quarter of all bidding wars have simply vanished. Sellers who were expecting six-figure offers over asking are now struggling to get any offer at all. So what happened? The same thing that's rattling the entire Bay Area: massive tech layoffs, shrinking stock portfolios, and a permanent shift to hybrid work. The tech wealth that once fueled this market has evaporated. The buyers who once competed for every listing are gone, and the new ones are no longer willing to pay a premium for proximity to an office they rarely visit. Fremont's entire economic foundation, built on tech salaries, stock bonuses, and relentless demand, is cracking. And as we keep driving deeper into Silicon Valley, it becomes clear this isn't just a slowdown, it's the start of a reckoning. If you're in the Bay Area, what are you seeing? Have layoffs or work-from-home shifts changed the housing market in your neighborhood? Number 5, San Ramon. We're still in the East Bay now, just a short drive over the hills to San Ramon, a city known for its immaculate master-planned neighborhoods, gleaming corporate campuses, and some of California's most coveted schools. For years, families paid a steep premium to buy into this picture-perfect lifestyle. But today, that dream is souring fast. The correction here isn't subtle, it's a full-blown slide, and the data leaves no room for denial. Let's start with Zillow. Their latest numbers show that home values in San Ramon have plunged 6.7% in just 1 year. That's not a cooling, that's a collapse. Realtor.com confirms the hit from the seller's side, with median listing prices down 5.5% compared to last year. Sellers can't even ask what their neighbors got 12 months ago. Redfin's closed sale data adds another layer of confirmation, reporting a 2.9% decline in actual sale prices. No matter which way you slice it, the direction is unmistakable. Values are heading down, and they're falling fast. But the most jaw-dropping figure, the one that really drives home how far things have flipped, comes again from Zillow. Brace yourself. 65.9% of all homes sold in San Ramon are now closing below their final list price, nearly 2/3 of all sales. Think about that. It's no longer a surprise when buyers get a discount, it's expected. The seller's fantasy of name-your-price dominance has been completely obliterated. The fear is spreading fast. Inventory is stacking up as anxious sellers rush to list before prices tumble further. Homes that once sparked bidding wars over a weekend are now languishing for weeks. We found one recent Redfin listing on Sapphire Court that sat for 39 days before finally selling for 4% under asking. A year ago, that same home would have been gone in 3 days for $100,000 over. This is the new reality, even for affluent enclaves like San Ramon. The myth of immunity, that wealthier zip codes are insulated from the crash, is disintegrating in real time. If prices are crumbling this quickly in one of the Bay Area's most desirable suburbs, the question isn't if the rest will follow, it's how far the bottom really is. What do you think? Are we looking at a temporary slide or the start of a deeper correction across California's elite markets? Number 4, Irvine. We're back on the road, cruising down the 5 freeway into the gleaming heart of Orange County. Irvine, one of the most carefully designed and famously expensive suburbs in the world. For decades, Irvine has been the definition of stability: spotless streets, top-tier schools, and sky-high property values. It's the kind of place people called recession-proof, the bluest of blue-chip real estate. But in 2025, even Irvine's polished perfection can't defy the gravity pulling the rest of California down. The numbers are brutal. Redfin reports that Irvine's median sale price has dropped 6.6% year over year. When the typical home costs around $1.6 million, that means the average homeowner just lost over $100,000 in equity in 12 months. That's not a dip, that's a seismic shift. And the slowdown isn't just about value, it's about movement. A year ago, the average home in Irvine sold in about 40 days. Now, according to Redfin, it's taking 58 days. Nearly 2 extra months of waiting, paying, and worrying. The once hyperactive market has hit a wall, and sellers are starting to panic. The panic is visible in the listings. A new report from Zillow shows that 29.2% of all homes on the market have had price cuts, up from just 9% a year ago. That's a 222% jump in seller distress. And if that wasn't bad enough, here's the number that really exposes the shift. 72.6%, nearly 3 out of 4 homes in Irvine are now selling below their list price. Think about that. This was a city where buyers used to beg, overbid, and waive inspections just to get in. Now sellers are the ones begging, slashing prices, throwing in upgrades, and praying for offers. The psychology of the market has completely flipped. The fear of missing out that drove prices into the stratosphere has transformed into a new kind of panic. The fear of being left holding the bag. Detached homes, down 6%. Condos and townhomes, down 5%. There's nowhere to hide. Even the famed Irvine company, with its pristine neighborhoods and perfect landscaping, can't build enough parks or bike paths to distract from the hard truth. Gravity always wins. Irvine, once seen as the ultimate safe haven, is now in full-scale correction. The question is, if this market isn't safe, is any market in California safe at all? What do you think? Is this just a stumble or the start of something much bigger? Number 3. Los Gatos. We've reached the epicenter of Silicon Valley wealth, Los Gatos, the postcard-perfect town nestled at the base of the Santa Cruz Mountains. This is the land of glassy mansions, luxury Teslas, and tech royalty. It's home to Netflix headquarters, a place where multi-million-dollar homes are as common as coffee shops. For years, Los Gatos has been the gold standard of stability, a market that simply didn't go down. But now, the illusion of invincibility is cracking wide open. The latest numbers tell a story that even the wealthiest can't ignore. Redfin's August data showed a staggering 10.8% year-over-year drop in home prices, one of the steepest declines in all of Silicon Valley. Prices have since clawed back slightly, with September showing a smaller 1.5% dip, but that kind of wild swing is a red flag. It signals volatility, uncertainty, and a market teetering on the edge. But the real story, the one you can feel when you walk these quiet, manicured streets, is the inventory crisis. Sellers here aren't used to waiting. They're used to bidding wars, to cash offers $500,000 over asking, to homes gone in a week. But those days are gone. Redfin's recent data paints a completely different picture. A home on Blossom Hill Road sat for 96 days before finally selling for 4% under asking. Another on Miller Hill Road languished for 98 days and ultimately sold for 7% less than the list price. That's over 3 months of sitting and hoping in one of the richest zip codes in the country. Zillow confirms the power shift. 53% of all homes sold in Los Gatos are now closing below list price. That means the majority of sellers, even the multi-millionaires, are cutting deals just to move their properties. What's happening here is bigger than a dip, it's a reckoning. The tech money that fueled this area's decades-long boom is drying up. Layoffs across Silicon Valley, plunging stock portfolios, and the end of the 0% interest rate era have gutted the pipeline of easy cash buyers. The homes remain, but the buyers are gone, and when confidence evaporates in a market that's built entirely on confidence, the fall is inevitable. Los Gatos is proving that no amount of wealth, prestige, or zip code can shield a housing market from reality. And the most shocking part? We're not done with Silicon Valley yet. The next stop shows just how deep this correction really goes. Number 2. Mountain View. We're now just a few minutes from the Googleplex, deep in the beating heart of Silicon Valley. Mountain View, the ultimate tech company town. For decades, this place wasn't seen as a housing market. It was a fortress. The logic was simple. As long as Google keeps growing, the local real estate will never fall. But that fortress is cracking, and fast. If you want undeniable proof that the tech slowdown has real-world consequences, you don't have to look any further. The data from Mountain View is a flashing red warning sign for the entire Bay Area. According to Redfin, the median sale price in Mountain View has dropped 4.9% year-over-year. Zillow echoes the decline, reporting a 3.1% fall in home values, while Realtor.com shows that sellers themselves are surrendering. Listing prices are now down 5.2%. Think about that. Sellers aren't just cutting after listing. They're starting low, knowing they can't even ask for last year's numbers. And even then, the buyers still aren't coming. This collapse isn't just about interest rates. It's about confidence, or rather the loss of it. The tech layoffs have gutted demand. Thousands of workers who once relied on stock options for down payments have seen their equity vanish. These are people who used to buy $2 million fixer-uppers without blinking. Now they're just hoping to keep their jobs, not add a mortgage to the mix. That frenzy, the energy that once defined the Bay Area market, is gone. Redfine's sale-to-list ratio shows homes that once sold over asking are now closing at asking, or often below it. Price cuts are surging, and the average days on market keeps creeping up week after week. Make no mistake, this isn't a temporary pause. Mountain View is the canary in the coal mine. When even Google's hometown, the nucleus of the tech world, is in a clear, measurable decline, the ripple effects won't stop here. The entire Bay Area real estate boom was built on one assumption, that tech growth would never slow. Now that foundation is shaking, and Mountain View is right at ground zero. And as alarming as this looks, brace yourself, because the next and final stop on our journey is even worse. The last suburb on our list isn't just declining, it's imploding. Number 1, Thousand Oaks. Our journey comes full circle as we head back down to Southern California, rolling off Highway 101 and into Ventura County. Welcome to Thousand Oaks, the final stop on our road trip, and the suburb facing what can only be described as a full-scale housing market collapse. For decades, Thousand Oaks has been a symbol of security, a place that topped the charts for safety, schools, and suburban perfection. It was the kind of town where people believed their home values would never fall. But that belief, that illusion of invincibility is gone. Completely gone. The numbers are devastating. According to Redfin's September 2025 report, the median sale price in Thousand Oaks has fallen 12% year over year. That's not a typo, 12%. On a $1.2 million home, that translates to an equity loss of roughly $144,000 in just 1 year. This isn't a dip, and it's not a cooling period. It's a meltdown, and it doesn't stop there. Zillow's data paints an equally grim picture. 59.3% of all sales in Thousand Oaks are now closing below list price. That means nearly 2/3 of sellers are slashing their expectations just to get a deal done. The market is overflowing with listings, and those homes are just sitting. Recent Redfin sales data reveals the brutal reality on the ground. A property on Holly Grove Street sat for 91 days before it finally sold. Another on Via Linus lingered for nearly 2 months and still had to close 3% under asking. These are not isolated cases. This is the new normal. So, what's behind the collapse? It's a perfect storm. Thousand Oaks is too far from major job centers for most commuters. It's located in a high wildfire risk zone, creating an insurance nightmare that's driving premiums through the roof. On top of that, much of its housing stock is aging, and today's affluent buyers aren't interested in dated floor plans or expensive renovations. The wealthy have stopped buying. The middle class can't afford to. The result is a vacuum, a once stable market left to fend for itself. Thousand Oaks has become the ultimate cautionary tale of how the California dream can quietly morph into a financial trap. Safety, prestige, good schools, none of it matters when the economics no longer work. And make no mistake, this isn't a warning about what's coming, it's already here. The meltdown is happening now. As we wrap up this road trip across California, the message is painfully clear. From the high desert of Lancaster to the tech corridors of Silicon Valley, the cracks have become chasms. Double-digit price drops, soaring days on market, and a total reversal of power. The buyers now hold all the cards. This isn't a pause. It's a historic reset, a housing market unraveling in real time. If you found this data-driven journey eye-opening, hit the like button, share this video with someone who needs to see it, and subscribe for more deep dives like this. And most importantly, drop a comment below. What are you seeing in your neighborhood? Thanks for coming along for the ride, and remember, the numbers never lie.